All right, all right, all right. I believe we are officially live right now. So if you're joining us live, hi. If you can hear me loud and clear, give me some hearts and some thumbs up and all of that good stuff. I'm about to. I did it a little bit different today. Normally we both are on the screen, but I'm gonna tee up my man Drew Shade here. Drew Shade is one of my tribe members. He's definitely a part of my tribe. He's somebody that I look to for advice on a wide variety of topics, actually, but most specifically mortgages, and he has a history in financial financial planning and advising also. So I just give him a ton of questions all the time. I feel like I'm definitely a well, I won't say what I am, but I ask a lot of questions, and I'm excited to have you guys have Drew here today. I'm going to ask him some questions. He's going to debunk some myths, and I'm going to bring him in right now. So here we are. This is the man, the legend, Drew Shade with Nordic Home Loans. Drew, thanks for being here.
Man, thank you. I'm gonna need to bring you with me everywhere I go. That's a heck of an intro. Yeah, you'd be like the old town crier in the olden days who introduces people. That's awesome. Thanks, man. I appreciate that.
Yeah, well, I forgot to ask your theme song, so that would have been more helpful too if I had that.
Definitely 99 Problems by Jay-Z, but I don't know if that's good for this call here. It's not very professional.
Well, I'll remember that for next time, and I'll be sure to help you out with that theme song intro. So, well, so speaking of professional, man, we have a lot of topics to cover, I have a lot of questions we've discussed. So normally these tribe calls, they're just kind of Q&A, right? Like it's like, who are you? Like, what's going on in your world right now? Like, how have you changed with COVID and stuff like that? And it's very just like conversational, but then people jump in and ask some questions and things. But for today, it's a little bit different because we have a focused topic, and it's been something that I've been asking you about for a long time. And as a real estate pro, I come across a scenario maybe where somebody could use a reverse mortgage, and they have a ton of questions, fears, uncertainty around it. Reverse mortgages kind of have a bad rap. And so for today's call, I figured let's not do Q&A. I asked you to put together a little bit of presentation material and just help me learn more, help people that are watching learn more about reverse mortgages and how it might be able to help them or clients if other real estate agents are watching, or maybe a parent or a grandparent or themselves. And so that's what we're going to do today, right?
Awesome. I love it. Yeah, I think it's important for everybody to watch, because whether it's somebody who's, you have to be 62 or above to get a reverse mortgage, but this is something that the people our age, the children of people who are reaching that age, need to also be aware of. I saw a meme a while back about, my parents are getting a reverse mortgage, and it was like they're gonna steal my inheritance, and it's that used appropriately, that really couldn't be further from the truth. But I think it's important for everybody to know, not just the seniors who might be taking out the reverse mortgage, but their family members, so that they can be comfortable and understand what their parents are potentially doing.
Yeah, no, that's a good point. That's a great point. I've had conversations with family members before, and they're like, they've said, but hey, can you tell me how much my dad's house is worth? Yeah, he has a reverse mortgage on it. Like it's like he doesn't own it or something like that. Anyhow, so today you're gonna debunk some of the myths around reverse mortgages.
Cool. Well, I have some, for the first part, like some of this stuff is, I try and make it, some of it's kind of higher level, but I've tried to put these slides together with visuals to make it more easily digestible. I think if I just talk, people are going to tune out and not understand what I'm talking about. But Let's do this. Let me see if I can share my screen here. Let me know if you can see it.
All right, I can see it. I'll add it here to the stream.
Okay.
Cool.
And everybody will have to bear with me. This is kind of altered a presentation I normally give to certified financial planners about integrating reverses into their clients' overall wealth strategies. But that's why the title is Reverse Mortgages for the Modern Financial Planner.
Okay.
And
sure.
let me know when it's up.
Most oftentimes your like sphere and network is financial planners, right?
Absolutely. So that's where my background is. I am on the board of the Financial Planning Association of Northern California. When it comes to reverse mortgages, I won't even say that like I'm an advocate. I probably would refuse to do one without a certified financial planner in the mix, because while they're a great tool and there are tons of advantages, you really need an expert there who is who's going to help you out for the long haul, not just once the thing gets established, but for the years, the entirety of the time that you live in the home and have that reverse mortgage. You're going to want an expert there to advise you. So that's why I present to financial planners so frequently.
Yeah. Okay.
So let's go. I start off with this quote on this presentation always. It's the great enemy of truth is very often not the lie, which is deliberate, contrived, and dishonest, but the myth, which is persistent, persuasive, and unrealistic. And I think that's so appropriate here, because when I bring up reverse mortgages, I mean, if you want to ruin like a good family gathering, bring up reverse mortgages, and you can just watch people's face go like I've heard awful things about them. They're terrible. And if you stop and ask, well, why? It's kind of like, well, I just know that, or I've just heard that, but not really a whole lot of why. And myths, I mean, this quote here it's prevalent in everything. Like if I were to ask you, Jeff, what color makes a bull mad? Red, right? We all know, oh, it's red. Bulls don't see color. Bulls don't have the cones in their eyes to sense color, so they see in black and white. So even though we all know that, it's not true. But that myth is very, very persistent. Everybody knows it. Yeah. And that's kind of the same thing with reverses. Everybody instinctively knows that they're really bad, or they're only for people who are really desperate. And again, it's one of those things that's just not necessarily the case.
Yeah.
Yeah. So I thought for us to have like an intelligent conversation about these, I think we need to first go back to basics. So we just have some like basic understanding of what a reverse mortgage is and how it works. Mm-hmm. So the absolute basics are that it is an FHA insured loan. So it's insured by the US government. It's available only on somebody's primary residence, and at least one of the borrowers has to be age 62. To dive into that a little deeper, you could have a married couple where the husband is 62 and the wife is 60, and you don't have to wait for both of them to be 62. I mean, in theory, you could have one spouse who's 62 and one spouse who's 25, and that 25-year-old would be able to stay in that house with the reverse mortgage for as long as they live, and as long as they want to stay there with no payment obligation. It gets maybe less advantageous on actuarial tables, but in theory, like that could happen. There's no monthly payment required for a reverse mortgage. And although you are obligated to pay your property taxes, your homeowner's insurance, and maintain the home, meaning like if a tree falls and crashes through your roof, like you got to get the roof repaired. And then also every person who gets a reverse mortgage is required to attend a counseling session prior to application, where an unbiased third-party counselor really educates them on everything and makes sure that they're fully aware of what they're doing. So it's a really good safeguard that's built in there so that people aren't pressured into doing anything or doing something without fully understanding everything. So I think that's a fantastic law.
Yeah.
So this next slide is basically a theme that I always tell people is that a reverse mortgage at its core, it's just a mortgage. Kind of like a Jeep or a Ferrari. They're both automobiles. Like one specializes in going really fast and one specializes in navigating trails. But at the end of the day, they're some seats and a steering wheel and four tires, and they're basically, for all intents and purposes, a similar thing, just different specialties. So for this analogy to kind of drive that point home, we have two clients, each have a $250,000 balance on a mortgage at 5%, each pay $2,651 a month. Both of them pay the house off in exactly 10 years at the same time. The question is, which one had the reverse? That right there is actually one of the misconceptions, that you can't make a payment on a reverse mortgage. You can absolutely make monthly payments and pay the balance down on a reverse. But that right there is just to drive home that these things are, at the end of the day, they're just a mortgage.
Which one had Which one did have the reverse?
I don't know. Tom Johnson had the reverse.
It's because it's irrelevant.
It's irrelevant.
Is the indication like both of them pay the house off, and either both of them or one of them or none of them could have had the reverse. It's
correct. Yeah, there's no way to know, because applying the same exact payment schedule, the both of them pay the house off. So it really is, at the end of the day, it's just a mortgage.
Yeah.
So a lot of people are probably familiar with a home equity line of credit, and a reverse mortgage does have some features that are similar to a home equity line of credit. I have here that obviously you retain ownership of the home with both, and they're both open-ended credit, which is a fancy way of saying that if you have a home equity line of credit, you can have a zero balance on it, and then if you're, a lot of people use them maybe to put in a pool or remodel the kitchen. You can say the kitchen remodel is going to be $20,000. You can pull $20,000 out, and you'll pay interest on the $20,000 while it's out, and then you can pay the balance back down to zero. And then maybe you want to put a pool in 2 years later. You can pull out the money to do that, and you can pay it down. So it's open-ended in that you can pull money out and put money back at your discretion. So both of these work that way. A home equity line of credit works that way, and a HECM, which is the fancy way of saying reverse mortgage, works that way again. It stands for a home equity conversion mortgage, for those who care. But then this is where
names for a reverse mortgage.
I'm sorry?
Are there any other names, fancy names?
HECM is the one I come across. I don't know if there are any. I don't know any other ones. I'm sure there are.
I heard John Travolta once say that. I can't remember what he called it.
So in Korea, they do refer to them as a house pension, which does sound a little nicer than a reverse mortgage.
Yeah,
I heard John Travolta telling Samuel L. Jackson about that the other day too.
Yeah, it was in Pulp Fiction. It was an interesting thing. If you guys don't know, there's a video.
In the cutting room floor, they ended up talking about hamburgers, Big Macs in France, but the original line was about reverse mortgages. You're absolutely right.
Yeah, the editor's cut. All right, sorry. Keep going.
So here's where they start to get some divergence. In a home equity line of credit, the unused amount doesn't grow. So if you have a $50,000 line of credit, in 5 years from now, you still have a $50,000 line of credit. In a HECM, it's different. We'll go over that in a subsequent slide. The line of credit actually grows over time. A home equity line of credit, I have here, it can't be called recast. Only the HECM has that. For those who can remember 2008, 2009, when we had a housing market crash, if somebody had a home equity line of credit, say $50,000, and the value of their home fell, the bank could cancel that line of credit, because in theory, right, they don't want you to be able to grab $50,000 and essentially have more than your home is worth in your pocket, because what are you going to do? You're going to walk away and leave them with the tab.
Yeah.
So with a HECM, that unused amount, or that principal limit, which we'll go into in a second, continues to grow every single year. So even if the home value has a decline, the HECM and the credit line continues to increase no matter what the value of the home's doing. The next one there, that it's non-recourse, that means that you never are obligated to pay back more than the value of the home, which is huge. That means that if you have at the time of either death or permanently moving out of the home, if you had a home equity loan and the balance was, X, but the home was worth less than X, you would owe the bank that difference. On a reverse mortgage, if the balance is, $600,000 and your home is only worth $400,000, you're not on the hook for that $200,000 difference there. It's zero recourse, which is huge.
No tax implications or anything like that. I mean, that's not, just zero.
Correct.
Cool.
Although I always have to say consult a tax professional because I can't give tax advice. And then the big one is there's no monthly payment requirement. We talked about that a minute ago, that you can absolutely make payments if you want to, but you are not obligated to make a monthly payment on a reverse mortgage.
Okay.
And if I keep popping up, I'm working on 2 monitors. A public service announcement: don't let your 3-year-old get to where your computer is, your laptop, because she can potentially drop it and shatter the screen, and then you have to run your presentation through a different monitor. So, all right. So quick primer on how reverses work. So here we have kind of maybe the more common conception of them, or perception of them, is in this case, typically the amount you're allowed to borrow is about half of the home's value. So for just this illustration, I use nice round numbers. We have a $500,000 home, a 5% interest rate, which is higher than they are currently, but it's a nice round number. So they can borrow about $250,000. And in this case, they do. They have a $250,000 loan balance. And in 10 years at 5%, that balance is going to grow to $407,223. And the principal limit, so the maximum loan amount they have, is also going to grow to $407,223. The reason for that is simple. The principal limit has to be whatever the maximum loan balance can be. So if the loan balance is going to increase every year as interest accrues, the principal limit has to grow with it, because otherwise it wouldn't be the max. You'd be over your maximum. Rather simple, but it's your credit line has to grow to accommodate your balance if your balance is growing too.
Got it. Yeah. So
interesting. But go ahead. It sounds like you have a question.
Yeah. So in other words, if you started this, you had a $500,000 home, and you took $250 from it. Maybe you owned it outright. You took the $250, and eventually you're not gonna get to five. You're not really going to get to 500,000 or exceed your principal limit, because your principal limit grows as well.
Correct. And your principal limit is always going to grow regardless of the home's value. What we'd like to see, and being that this is, FHA, although they insure this against you being upside down, they don't necessarily want that to happen, because that would be very expensive. So there are actuarial tables to make sure, or to hopefully keep you from never exceeding what your home's value is. But when it comes to that principal limit, your credit line, yes, that will always go up to accommodate the balance.
Yeah.
So what we're going to look at next is something that's going to be kind of the inverse of this, which is same house, same interest, same principal limit, but in this case, the client wasn't interested in or didn't need all that funding. So maybe they're not, maybe they own the home free and clear, and they just want this line of credit there. So let's say they start off with only a $10,000 balance. That means in year one, they have a $240,000 well that they can go to. There is a safeguard where in year one, technically, unless they're using it for a purchase, they're capped at like 60% of that because they don't want people just taking all the money out and like buying a boat or spending it all down in one fell swoop. But from year 2 on, like that credit line is fully available to them. Here's where it gets interesting though. Remember that principal limit's going to grow by that interest rate factor. So 10 years from now, just like in our other example, we have a principal limit of $407,223. The loan balance is only grown to $16,289 because it's only compounding off that starting amount of $10,000. So what was a $240,000 credit line in year 1, in year 10 is just under a $400,000 credit line. So it's a huge safety net that's available in there for that client to be able to draw from. I want to take a second for that to really sink in. Like, no matter what the value of the home did, that $500,000 house could have dropped in value by 50%, and that $391,000 credit line is still available.
Yeah. So what if you own your house free and clear and you want to possibly tap into your home at some point in time, or you think you might, then taking out a very, very, very small loan, opening up a reverse mortgage and allowing that principal limit to grow while you don't even really need it would be, that's the goal, right? Like that's the perfect scenario.
That can very, very well fit into somebody's financial plan. We're starting to see, and I'm going to jump ahead of myself a little bit, but people often think of these as like being a last resort item of somebody spent down their entire nest egg and they need money, so they do a reverse. Yeah. We're now seeing people who have estates, liquid assets in excess of several $1 million, putting one of these on their home for the liquidity reason or for having that reserve. There's one thing when it comes to retirement, people understand this, right? They understand that you spend the first half or 2/3 of your life earning funds, saving it so that in the latter part of your life, you can draw down from it to live off of. Kind of like a squirrel collecting nuts so that they can survive through the winter. But where the disconnect is that the average baby boomer right now, more than half their net worth is in their home equity. And at times it can be more strategic to use the home equity to fund their lifestyle than their portfolio. And we'll get into that in a minute.
Okay.
All right. So on that note, I guess we can kind of get into maybe some of the myths that you've heard, and I've got a couple slides to kind of illustrate them. So
okay.
What do you have here as far as what people think about reverses?
I have what was your question?
I wanted to talk a little, maybe start some of the myth busting.
Yeah.
I think people watching should have a little bit more of a primer of like, what are these things and how they work.
Totally agree. So I have your screen here still, so I'll bring that back up because I'm sure you have more information. But okay, so before we get into myth busting, I have a couple of questions from the crowd.
Right? Okay, cool.
One of them is related to a HELOC, and we're not talking about reverse mortgages. Okay. However, you're my mortgage guy, and I want to ask this question. So outside of a reverse mortgage, is a HELOC the best way to finance a pool? Additionally, is it possible to get financing with that? So let's answer that question. There's another one also. Actually, no. A HELOC also. Additionally, is it possible to get a HELOC or get that type of financing without your traditional 2-year history of income?
Ooh, good question. So I can't say whether or not it's the best way to do a pool, but it is a very good option. I don't want to say it's the best, and I don't mean that in the sense that there is some other better either. It's on a case-by-case basis, right? So every situation is different and should be evaluated. but it's a good option. I mean, if you have, if you're looking at financing the pool, I would look at if the builder offers financing and what the terms are of that financing, and then compare that to the terms of a home equity line of credit, and then make a decision based on those factors.
So, because to speak to a point that you brought up earlier, if which there's no indication of this happening just yet, but if the value of your home went down, like you said, the bank could potentially hit you up and say, hey, we're going to close this line of credit, right? And then it becomes more of a mortgage or more of a loan, and you have to figure out what the terms of that loan are versus just your.
Correct. Although if you're financing it through the pool builder, if they offer financing, it's going to be a similar term there too, right? It's going to be a loan amount with a repayment schedule. So at that point, I would look at more so what's the term on it, what's the rate, what are the costs, and then make a decision by comparing those two options.
Cool.
Yeah.
And then the second question, which this is probably well, you know what? Actually, I'm gonna skip to one of my. Would it mess you up? Because I told you what some of the myths were. We talked about the myths, right? Yeah. Would it mess you up if I jump to one?
No, go for it.
So the question was, if someone has a reverse mortgage and passes away, can someone, like a family member, assume that mortgage?
It's a good question. And the answer is no. So that reverse mortgage is specific to the homeowner. So if the homeowner passes away, if somebody is, go ahead.
Well, I was going to say, all right. So the answer is no. Now, my myth is, well, before you explain why, let's go into the myth, right?
Okay.
The myth that I've heard around that, right, like, is when you do a reverse mortgage, you actually sign over the title of your home, right? And that's, I think, why people are afraid that they can't assume. That's, I think, the reason they think they can't assume the mortgage. So when you pass away or move out, the bank gets your house.
Right. So that is the number one myth. And the fact is that not only is it not true, it never has been true. Back to that initial or earlier slide where I said it's just a mortgage. It's just like if they have a reverse with a balance of 100,000, or they have a traditional forward mortgage with a balance of 100,000, when the heirs inherit the estate and they inherit that home, they have some choices. Most of the time now, we don't see kind of legacy homes like we did 100 years ago when people had family farms and that farm would like pass through generations and stay in the family. Now when somebody passes and they own a home, almost universally the heirs sell the home. And they, if there are multiple heirs, they split the proceeds. And just like if there was a traditional mortgage, they'll sell the home and they'll settle the debt, and then what's left will be split among them. So same exact thing. It's not, the bank doesn't, if it's a $500,000 home and there's $100,000 balance, it doesn't mean that the bank gets to cash in on that $400,000 in equity. It goes to the heirs.
Yeah. So same. Yeah. And so just like you said, same with the regular mortgage. A regular mortgage, you don't assume you can't assume a mortgage, right? Or
some mortgages are assumable, but with the reverse, there are the qualification issues with like age and whatnot. So that person, that if the heir was 62 and above, the heir could absolutely obtain their own reverse mortgage, and if they moved into the home, they could essentially use the reverse mortgage to pay off their the person who left them the home's reverse mortgage, but they can't assume it. They'd have to qualify for their own.
Yeah. Okay. That's kind of a funny way of bringing in the first myth, but hopefully I didn't rattle that too much. So is it okay to go on to the next myth?
Yeah, absolutely.
It's kind of a good segue into this. A reverse mortgage robs the family of their inheritance, or robs the kids of their inheritance.
Yes. So let's start back at that basic assumption that in retirement, in order to fund a retirement, most people are going to be spending down a mountain of assets that they've accumulated over the previous, say, 40 years, right? And I have this slide here. It says, would you rather? And would you rather inherit a home worth $600,000 with no mortgage or the same house with a $212,000 mortgage? Instinctively, how are people going to answer that question?
No mortgage.
No mortgage, right? $600,000. If they have a mortgage, now I'm down to, what is that, $388? But would $1 million change your mind? And this gets into one of the more complex strategies this is why I advocate for having a financial planner on board over the life of the loan. And in this scenario, what we're using is, this is what we call sequence of returns risks, which means that somebody retires and early on in their retirement, we have bad outcomes in the stock market or in their portfolio. So
like right now.
What's that?
Like right now.
Kind of like right now. Like if you retired at the beginning of this year and then 2 months into it, you saw your portfolio drop substantially, that might kind of worry you. In this illustration, we're using a portfolio that's blended with 60% stock exposure and 40% bond exposure, which is appropriate for somebody who's in their 60s. And we went back to the year 1973 for this for a couple of reasons. Number one, because that shows a good sequence of return risk event. We wanted to keep 2008 out of it because we didn't want to come across like we're playing off of like a huge meltdown. It's funny because now it's like, well, we just had this black swan event with the coronavirus. We're kind of experiencing something similar, although we are seeing the markets rebound for the time being. It'll be interesting to see how this plays out over the next several months or even years with the long-term effects of it. But in this illustration, we have these people who they have their income goals are going to be partially funded by Social Security, but they're using their portfolio starting out in year one to substitute for the last $26,000 they need to live their life. And you'll see over time that that withdrawal rate goes up because of inflation, so they need to pull out more and more each year. And what happens in this case is that in year one, and they started out with a $400,000 portfolio. Year one, the portfolio lost 11%, and in year two, it lost 15%. So that $400,000 portfolio by the third year is only worth $225,000. And we have several years of positive returns. We get down to 1990, portfolio loses 3.5%. The balance of the portfolio is at 281, but if we go down all the way to 1996, we've got, we're down to 61,000, and we go a couple years later and we're broke. So at age 87, there's no money left.
Yeah. Which
is scary. There's when they survey people, people who are entering retirement and ask them what their biggest fear is, their biggest fear is outliving their money. More than death, more than sharks, more than tornadoes, it's outliving their money. So what if this same exact scenario, the person had established a home equity line a home equity conversion mortgage? And go ahead.
Well, on this chart, there is a HECM at the or is that where you're going right now? Or
that's where I'm going with it.
Okay, yeah, go ahead. Sorry.
Yeah, because this one they're going to use it as a last resort. They've spent down all their money, they're broke, and now they have to get a HECM because they don't have any other source to fund their lifestyle, and they're living past, they're 87 and they're still alive. It's of note too that the life expectancy in the United States is about 82 to 83 years old, but that's the life expectancy from birth. So if you've made it to age 62, and haven't fallen victim to childhood cancers or wars or car accidents or all these things that pull that number down, once you've made it to 62, your life expectancy is higher than 82 or 83. It's actually about 7 years higher than that. So that's of notice. People need to really start thinking about the fact that they may live a lot longer than they think. So let's look at this if they instead used a coordinated approach. And so what this family is going to do in this instance is when there is a down year in their portfolio, they're going to substitute their withdrawal from their home equity instead of taking it out of the portfolio. And the effect of this is that in the subsequent rebound from a poor performing market, those funds that they otherwise would have removed from the portfolio get to remain in the portfolio and take part in the recovery. So we see in 1974 and 1975, they've taken money from their home equity, and then 76 through 1990, they continue with the old plan of just taking their income from their portfolio. Take money again in 91, money again in 2002. And at this point, the balance on their home equity conversion mortgage would have come to about $212,000. However, look at what their portfolio value is there. It's over $1 million. And of note is that 2 years earlier was $1.2 million. So there was some market losses there, and it's still $1 million. So that's why I asked that question of, would $1 million change your mind? Of course, it sounds great to inherit a home with no mortgage on it, but if it's part of a coordinated strategy and the overall net worth of the client is substantially higher, it really makes sense. And this is, again, where it comes into having that trusted, certified financial planner on board to help navigate these events and make sure that we're deriving our income from the most efficient source at the time.
Yeah.
So, and that's a very long-winded way of explaining that, no, it doesn't necessarily rob the heirs of their inheritance. Used correctly, it can actually be very generous to that estate.
Cool.
Yeah.
I like it. Yeah. It made me think of the question, would you rather have $1 million cash right now, or would you rather have a penny that doubles every day for the next 30 days?
That's perfect analogy for it. It's 100% that. The $1 million sounds good, but the math works out for the penny that doubles.
Yeah. All right. Yeah. Myth number 3, a reverse mortgage. Well, we just kind of covered this, but I think you have more you might want to dive a little bit deeper. Is a reverse mortgage is only to be used as a last result.
Yeah. So this is a super persistent myth. FINRA, which is the Financial Industry Regulatory Authority, their language only up until about 2 years ago had this advice. So for financial planners, hey, you should only be using this as a last resort. So I've had financial planners where I've been asked, please don't send this to my business email, because if it comes up in an audit, I'm going to have to explain why I'm talking about this. FINRA removed that language, and they removed it because academic research from MIT, from University of Pennsylvania, from Stanford has proven this wrong. So these very, very smart individuals, some of which have Nobel Prizes, have actually done the math on all of this and have shown that just like we showed with the illustration on the screen, that the last resort provides significantly worse outcomes than the coordinated approach. But it's going to be a long time, I think, before that myth is fully debunked and people, look at the actual data. It's unfortunate, but we are very much hardwired to not think, right? If we had to think about everything and analyze every bit of data every day, we would never get anything accomplished. So we're wired to make snap decisions. And so that in this case doesn't work well for us, because our snap decision is not the best decision.
Well, and also we go towards what's comfortable, right? And thinking about, 10 years from now, am I going to need these? Am I going to need an emergency fund? Am I, do I want to deal with, submitting an application, or just like, we just don't do things that make us uncomfortable, and then we pay for it later, and or hopefully
some of this stuff is kind of icky. Like, people don't like thinking about the fact that they're not going to live forever. People don't like thinking about the fact that later in life they may need long-term care. They're not pleasant things, but they're reality. And if they're addressed, just like anything, the earlier you address something and prepare for it, the better your outcome is going to be.
Quick question, does a home with a reverse mortgage have to be your primary residence?
Yes. So it absolutely has to. One of the requirements is you have to live in the home. That's why if somebody reaches the point where they can no longer live in the home and they have to, say, move to like a memory care facility, if they don't have a spouse, if it's just them, then the reverse mortgage will need to be settled within the next 6 months. And I'll give the caveat there that it's not like they're going to show up on day 6 months and a day and be like, we're foreclosing on the house. But as long as they need to be making arrangements. So the home needs to be put on the market, or the balance needs to be paid off. So yeah, one of the requirements is you have to be living in the home and have to be your primary residence.
Yeah. Myth, you ready?
Yeah.
Myth number 4. If I owe more than my home is worth, the bank will take it away.
Right. The old foreclosure myth. That is incorrect. As we talked about, it's a zero recourse loan. At the onset of applying for and funding a reverse mortgage, there's a mortgage insurance premium. If people are familiar with FHA mortgages, they also have a mortgage insurance premium up front. That mortgage insurance premium is insuring you against that recourse. So if you have a home that's worth $400,000 and your balance has gone to $500,000, you'll pay back the $400,000, and that last $100,000, they can't go after the estate for it. It's the loss is incurred by somebody other than the homeowner.
Okay. Okay. Myth number 5. I like this one. Myth number 5. I have to own my home outright in order to use a reverse mortgage.
Right. So incorrect, but they do have to have considerable equity in the home, about 50%. So unfortunately, if somebody owes 80% of their home's value, they're not going to be able to do a reverse mortgage without coming up with a substantial amount of cash to pay the balance down. And the reason for that makes sense, right? Because that balance is going to grow, and we don't want that balance to exceed the value of the home. We're insured in case it happens, but if we're letting somebody borrow 80% of their home's value and not make a payment on it, and interest is accruing, they're going to hit that ceiling a lot quicker, and that's what needs to be avoided. So, but let's say somebody has a $500,000 house and a $200,000 mortgage balance. If they want to stay in that home, they could convert that mortgage into a reverse mortgage and utilize some of the features that we've talked about, or get rid of their payment and then not have put less stress on their other assets because they're not servicing that debt anymore. Or what we're seeing, and you and I have seen this together, is people who are right-sizing their home, and maybe they have a mortgage balance on the other home, and they're looking at their next home and how do they make that work. Or maybe a lot of people are thinking, oh, I can sell my home and I can take, I have $300,000 in equity. I can put that down. What can I get for 300,000? And I mean, you're the realtor. What can people get for 300,000 right now?
Nothing, not if they're right size. So I like you kind of you drop that in there, but right sizing, right? It's not always necessarily a downsize. It's not, sometimes it's in some cases what you really need is actually maybe even a little bit more of an upgrade from what you have right now. And yeah, you can't
Absolutely
get 300,000, or at least not really.
One of my closest friends is looking at doing this right now, and I think she's watching. So hi, Dina. But she is looking at potentially right-sizing her home, and I don't think that what she's looking at is any smaller than what she has, but it's single level. As we age, we don't necessarily want to be going up and down stairs. It has a bigger yard. She has a dog, so it's right-sizing her house. But yeah, you're right. It doesn't necessarily mean that she's moving into a smaller home.
Yeah. So we've seen that too, where and you're sorry, I'm hijacking your myth busting here, but
we go for it.
We work together.
A lot. I could use a break.
Yeah. We've worked together on to help a client that, they're like, hey, we got cash. We have cash, but we don't have a ton of income, right? We have our investment accounts. We could pull from that as additional income, but we don't really want to yet. And the house that we've got, 300 or 400 cash that we could grab, but we don't want to live in a $300,000 or $400,000 house. Our taste is really more like 5 or 6, but we can't afford a $500,000 mortgage or even a $600,000 mortgage, especially. So what do we do? And so then what did we do? I guess, right?
Yeah. So we used a reverse to buy the house. I think there's one other, I don't know if I'm going down a rabbit hole, but there was another portion to this, which is that they were, in this instance, they were moving from further away, and they were going to sell their other home. And I think their thought was, all right, we're going to take the proceeds from the other house and use that to supplement and buy this house.
Yeah.
But the problem is that they were selling in a colder climate in November, or they were moving, I should say, and it was not possible to list their home with 8 feet of snow outside the door. They needed to wait for the springtime for that to happen. And so they were kind of in a pinch, right? They needed that money from the other home. So we used the reverse mortgage as a bridge. We substituted the funds that they were going to get there from the sale of that house and allowed them to move when they wanted to in January. And then they sold their home 4 months later. And then they had the option at that point to take the proceeds and pay the reverse mortgage balance down, keeping it open for the features that are there for that line of credit. But what they did was they opened up options. They didn't exhaust their investment accounts. They didn't put strain on themselves. They were able to accomplish exactly what they wanted without putting undue strain on their financial situation.
I think one of the missing pieces so far that we haven't mentioned, because I don't really know how to put this into a myth, but it makes me think of it now. Because it's not a myth, I guess, but I think one of the benefits is you don't have to make any money. You only have to have enough income to essentially pay taxes and living expenses, right? Like, you do not have to qualify for a $250,000 mortgage, even though you technically have a $250,000 mortgage on your $500,000 reverse mortgage.
Right. So because we're dealing with a potentially vulnerable population, which is, like, elder abuse is a real thing, there is an assessment of the ability to kind of maintain their lifestyle or to pay for things. But what we don't have is that stringent debt to income ratio like we do on a traditional mortgage, where they say, okay, our maximum debt to income ratio is 43%. And if you exceed that, then we are not going to lend you this money, because we have to show an ability to repay the mortgage. because on a reverse, we don't have to show an ability to repay the mortgage because there is no obligation, then the income requirements become a little looser. We have to show that we have the ability to have homeowners insurance and the ability to pay our property taxes and to live, but somebody who's earning Social Security or maybe has a small pension where they otherwise would not be able to qualify for a traditional mortgage on the house they want, might be able to instead get the reverse because the income requirements are not so stringent.
Yeah.
Like if we can eliminate a $2,200 monthly obligation from the equation, all of a sudden their debt to income ratio is a lot different than if we have that traditional mortgage servicing.
Right. Well, and it's just like you said about the bridge loan, right? Like they owned a home, their equity was, the majority of the equity was there. They couldn't qualify to continue to own that home because they still had a mortgage on, a little bit of a mortgage on that. They couldn't qualify to have that mortgage and buy another one on a traditional mortgage. They had to do a reverse.
Correct. I'm glad you brought that up because I forgot about that portion of the equation. Yes, they had a mortgage on that other home, and yeah, their debt to income ratio would have been on a fixed income, having to show that they're servicing two different mortgages with a requirement of a monthly payment. Yeah. And absolutely, that's how we made it work.
Yeah. Reverse purchase. Is that what it's called, or would you call it a HECM?
HECM purchase, reverse purchase. It's all the same thing.
Okay. Yeah. Home.
You know what I'm going to do is I'm going to switch my monitor real quick. There we go. I still had the slide up, so this is better.
Is there any more slides or no?
No, that's. I mean, I can go back to it if I need to, but cool. Yeah, I think we're good.
Yeah. Hey. All right. So you busted 5 myths, right? And provided a ton of information and value. Thank you. This is going to live on. People will see it on YouTube and Facebook and stuff like that. So if people that are watching have additional questions about regular mortgages, about HECMs or house pensions or anything related to reverse mortgages, what is the best way for them to get a hold of you?
So they can email me at drew@nordichomeloans.com. Not to toot my own horn, but I'm a wealth of knowledge on the subject. I also, as I said earlier, I'm involved with the Financial Planning Association, so I can help get people in touch with an intelligent financial planner who can also give them some guidance and let them know if this is right for them. I think one of the real advantages that I have is the vast majority of people who do reverse mortgages only do reverses. And there's a saying that like if the only tool you have is a hammer, then everything looks like a nail. I'm not in that camp. So I do all kinds of mortgages. So if a reverse mortgage is not right for the situation, I'm not going to try and steer somebody into one. And I think that's important to note because it is a case by case. Just like you asked me about the pool, it's like I can't answer that question because it's every scenario is different, and you want to look at all the specifics for the individual.
Yeah, I will attest to you being a wealth of knowledge on the topic and several other topics as well too. So if you guys are watching this live now, definitely take Drew up on his offer to answer questions. And I would encourage you to ask him all the questions that you might have just in life and hit him up because he tends to have some answers. But no, seriously, man. Thank you. We have some comments here. Hey, thank you, Drew. Very informative. Thanks and we included some captions here. So that was from Dina. But
she just because I gave her a shout out in the presentation.
So cool. Well, hey, thanks, man, for doing this. I've been talking about wanting to put this together for a long time. I think this is probably going to be a preliminary thing to what I would really like to do is more of a formal presentation where we really get some folks in here that like seriously want to talk shop about doing either a reverse mortgage purchase or doing a reverse mortgage. So keep a lookout for all that you're watching. We might do a seminar or something like that coming up here pretty soon.
Cool. Hey, thank you so much for having me. This is fun. I'm a bit of a nerd on these things, so I kind of like getting to talk about it. So thank you.
Yeah, absolutely, man. Well, thank you, and goodbye, everybody that's watching. Appreciate you. Make sure you drop your comments or questions, and hit up Drew if you need anything at all. Drew at NordicHomeLoans.com.
Awesome. Thank you, everybody. Much appreciated. Thank you, Jeff.